Good morning, everyone. Thanks again for joining us today. Welcome to presentation number 4 out of 5 in the series we've got going with Morgan Hohbein, joining us from Assurity in Lincoln, Nebraska. We'll jump right in here, but real quick, if you have any questions, feel free to type those into the questions box on the right-hand side of your screen. We'll make sure they all get answered after the presentation, and these always go much better when you guys ask questions, so don't be shy about that. Afterwards, feel free to give us a call to get a copy of the presentation, answer any other questions you might have, or to get any kind of materials you think you might want. And with that, I'll thank you again for joining us, and I'll hand it off to Morgan.
Perfect. Thanks, Sean. Thanks for the introduction. And like Sean said, this is our 4th presentation out of 5, the final one in the Life series. So next week we'll be diving into disability a little bit. So this last one is going to be on our new single premium whole life product. So we've had single premium whole life for a while, but recently made some changes and some upgrades to it. So we're going to talk about how we made that product just even better, go through the different changes, and then some sales ideas as well. I think I have 3 different sales ideas to go through with you today because the product's pretty simple and cut and dry, so we really want to get into more detail about how to go about selling this and what the market looks like and all of that. So we will get started here. Again, I am with Assurity, and we are located just down the street from Art Jetter in Lincoln, Nebraska, and we've been here since the late 1800s, so we've been around for a long time, over a century. So we have an A- AM Best rating. We're considered a one-stop shop because we have all sorts of products to offer on both the life and health side, and then also annuities, simplified and full medical underwriting. So lots to choose from. And my name is Morgan Hohbein. I am the regional sales coordinator here. And Paige Phelps and I work as a regional team and work pretty closely with the Art Jetter group. So you might see her name kind of pop up every now and again. So starting off pretty simple here, just want to go through the product highlights. So I'll go through what the highlights are now, and then I will go back and highlight some of the changes that we've made just so you know what's different, because you might be used to our older product. So I just want to make sure you're familiar with all those. So issue ages, we start at 15 days and go all the way up to 85 years. Benefit amounts, you'll see there, those are the minimums. So for the younger ages, we start at 10,000. Older ages will start at 5,000 and go up. There's the underwriting classes there. We do have a juvenile underwriting class that is new. And then it is guaranteed to age 121. There are non-medical limits built in there as well, so keep that in mind for those face amounts that are listed. So 700,000 for the younger ages, and then 450 and under for the older ages. So again, that would be non-medical, no paramed, anything like that. They might have to do a phone interview, but that would be about the most we would need from them. The riders on there are 2 available. So the single premium insurance rider, or as I like to call it, just the cash value enhancement rider. So it really just enhances that cash value there and increases the death benefit. So single premium insurance rider, and then our accelerated benefits rider, and this works exactly the same as the one that's on all of our permanent life products as well as our term life products. So you might be familiar with that if you've looked into any of our other life products as well. But this one accelerates benefits up to $250,000 if someone is deemed terminally ill or is put in a nursing home full-time due to that illness or age or whatnot. So we'll accelerate the benefits up to $250,000, and that is included with the product on that policy, so no extra cost there to add that on. So the competitive advantages, and this is going to kind of touch on some of the changes that we made to become more competitive. So that issue age was a change that we made. We used to be up to age 80, and we did increase that to 85, so it's a little bit more an industry standard now. And then we moved the the SPIR, the cash value rider, to be available through a Table 8. So it is open to more of those differently rated individuals. It is also repriced. So we went with the new CSO table, so it's repriced based off of those. More competitive commissions. This is probably the biggest change and the most exciting change for agents, obviously. So we are more competitive and more in line with the industry. So we not only created a better product, but we're going to pay you a lot better. So you'll see that as well. It's a strong death benefit, and then the cash value growth is a lot better than it was. So a lot of great advantages there. I keep saying we're kind of aligned with the industry now, but I would say we are almost more competitive as well. So the market that we see it in the most would be baby boomers in a great wealth transfer. So again, we'll see it also in the juvenile space for gifting and stuff like that, but we will see it most often in the baby boomer age group. So, that middle age to almost to the older ages for that great wealth transfer, and just transferring all of that into something that provides them with a little more cash value growth, a higher interest rate, while also keeping a steadily growing death benefit. So who is that market? Again, it's age 60 and plus, those baby boomers. It could even reach into the 50s a little bit. Relatively healthy, and they have non-qualified assets that they want to pass on to their heirs. So again, it is just transferring that wealth to something that's going to help it grow a little more, that cash value grow a little more, and also help that death benefit grow at the same time. So where CDs and stuff and savings accounts and stuff like that aren't going to have that same growth, we can offer that with our single premium whole life. So why would they want to use a single premium whole life over something else? So they'll have an immediate increase in their estate value just because of the interest that's there and the cash value. Accessible cash value, so they can borrow from that, loans and all of that at any time. It is a tax-free death benefit, so that is not something you will see with other savings type plans, CDs and stuff like that. And then the accelerated benefits rider kind of works similarly to a long-term care rider, which is something that's commonly asked for throughout the market. So again, they can accelerate those benefits up to $250,000, and that is built into the policy as well. So jumping right into that case study for the baby boomer era and the wealth transfer, which again is our most commonly seen kind of bill or plan that we see with these. So we have a 72-year-old female, and she has $30,000 sitting in CDs. So again, not a lot of growth there. So she's looking to pass on her money to her grandkids to help with college expenses. So again, it is transferring that money in order to leave more for their heirs. So here's the illustration. Again, we had $30,000, so you'll see that up there with the initial annual premium, and then you'll see the initial death benefit. She already gains a little over $10,000 on that, so it's going to start out at $40,658, and you'll see by year 20, so that's at the age of 92, she's going to have cash value of $45,207, so a growth of over $15,000. But that death benefit has been steadily rising as well, and it's going to be at almost $53,000. So again, with the CD, it's going to grow, but it's going to grow very slowly, and she's not going to have a death benefit. Yeah, perfect. So moving on to the next target market, one that we see pretty commonly is also pre-retirement, so kind of the younger ages. Now, some people have some questions on this, and I'll just kind of where you can find these people. because you won't see a ton of this, people with that much money to kind of put away. So I'll kind of go into that in a little bit and where we see this most often. But it's age 45 to 55, a relatively healthy individual who has an accumulation of assets. So they may have come into money through maybe a family member that passed away and they left money to them. So an inheritance. It could be maybe a settlement, something like that. So they've come into an accumulation of money and they need somewhere to put it that's going to grow their cash. So again, why would they choose a single premium whole life? That tax-free death benefit, tax-deferred growth as well. The accelerated benefits rider, so that's just kind of an added bonus since it isn't an additional cost. Just with the growth potential here. So we have a guaranteed side and a non-guaranteed side, which you can see on the illustration. So it's guaranteed to grow at least 3%. We're averaging at least 4% on the non-guaranteed side, but it's actually pushing about 5% right now, which is a great return on your investment. So it's growing very steadily on both the cash value and the death benefit side. So it's kind of nice to have both of those as a cushion. So the case study we have here, we have a 45-year-old male. He has $500,000 in his portfolio. Again, this is sometimes where I get pushback because they're like, where do you find a 45-year-old with just $500,000 sitting around? Well, there's a lot of instances that this could happen in. Hey, maybe you have a lottery winner. Maybe you have just someone who came into money through an inheritance that was left to them. You know, parents are getting kind of to that age where they're getting sick or passing away. Maybe their grandparent has passed away, an aunt and uncle, something like that. And he has $500,000 in his portfolio. He wants to allocate $100,000 to a secure base. So again, they're going to get that security with the guaranteed side at 3%. So situation, again, $100,000 to put into a secure fund, earns 3% interest compounded annually on that guaranteed side. So he's going to have a gain of $80,000 after 20 years for a total of $180,611 after 20 years. So I'll show you that on the illustration here and what that looks like here in a second. So he's putting $100,000 into a single premium whole life. So he's putting $50,000 into the base and then the other $50,000 into that single premium insurance rider or the cash value enhancement rider, just to grow that cash value a little faster. Since he is younger, he has the time to be able to do that. So the non-guaranteed cash value is going to be at almost $200,000 at the age of 65, so in only 20 years. And again, that's going to be at about retirement age. So he could use that to supplement his retirement as well. And that is at an interest rate of 4.82. So I told you it was almost at 5% right now. And that's kind of where it's been sitting actually for a little while. So that's on the non-guaranteed side. And then the non-guaranteed death benefit at age 65 is going to be at over $400,000. So that's an awesome death benefit increase there. So that rate of return is at a little over 10%. So here's what that illustration looks like. So that initial death benefit, just putting $100,000 into that single premium rider, is at $323. So that's an awesome initial death benefit to start out with. And the cash value is going to start out at $83,000, but by year 20, we're going to have almost $200,000. And again, he can borrow from that. He can take loans. He can surrender it, whatever he needs to do. But by the time he hits that retirement age, he's going to have double what he put in, and that can be used to just supplement his retirement, whatever his retirement plan is. And here are the interest rates like I talked about. So this will be included on an illustration as well, so you can kind of see what that looks like. So this is the internal rate of return. So we have the 4.82 at age 65 and then over 10% for that death benefit. Another target market that we see actually quite often too, and we had a whole presentation on this a few weeks ago, so the juvenile market. We don't see it as often as the wealth transfer, that's definitely the most popular by far, but it has been popular for gifting purposes. So who do we often see? We often see grandparents who want to leave money for their grandkids. So the situation here, we'll go through this case study. We have a 5-year-old granddaughter, and they want to put $5,000 into a premium. So again, single premium, they have $5,000 they want to gift to each of their grandchildren, whatnot. So they put $25,000 in the base, $25,000 into the single premium insurance rider. So we're going to increase that cash value a little faster. So the total death benefit at the end of the first year is actually at $65,000. So that's pretty awesome death benefit there. And I think as far as the juvenile goes, it's not a large sum of money by any means, but it's a great opener, a great door opener to talk about that single premium whole life product. So, and it's a great way to kind of gain them as a client as well and kind of talk to them about their own, retirement plans, their own financial plans, their wealth transfer plans, and all of that. So it's a great door opener. While it might not, gain you a ton of commission by any means, just off of the juvenile, it's, again, a great conversation starter. So here's what the illustration looks like for that 5-year-old. Again, we're putting that $5,000 in, and after the first year, we have $65,000. Looking into her college years, so about age 18, she's going to have just about $7,000 in cash value there. At the end of college, she'll be pushing a little over $8,000. So again, it's starting out with $5,000. It's something. It's a door opener. It's a gift that the grandparent's giving the child. So maybe the death benefit isn't important to them, but the cash value is just to help the child out with tuition expenses, maybe living expenses later on down the road, and whatnot. So kind of back to that, I'm going to open up the chat box. I told Sean this would be kind of a quick one. So please feel free to type in the chat box if you have any questions. I will move on to the next slide while you're thinking of those questions. Prague is the next place we're going on our leaders conference, and any of you contracted agents with Assurity can qualify for it as an individual producer. So keep that in mind. We are heading to Prague for 2020, and this would be the qualifying dates for that premium, to bring that premium in the door, would be January 1st of this year to the end of the year, so December 31st. And if you aren't yet contracted, we will prorate that amount that we would need in order to qualify. So keep that in mind. It's a pretty fun trip. We always have a lot of really awesome once-in-a-lifetime things planned. So again, all of you can qualify. And if you do have any questions about becoming contracted or would like to become contracted, please talk to Sean or anyone at ArtJetter afterwards, and they will help you with that. So with that, do we have any questions?
We just had one. So far, it was where's the product approved? This new product approved so far. And it is available in all states besides California and New York, right?
Yeah, so actually good news on that. So I'm glad you asked. It's not approved in New York, but it was approved in California recently. So on March 15th, so in just 3 days, it will go live in California. So all you California agents out there, the 15th is the big day. So we've been waiting for this one for a little while. So New York, we don't have any plans, obviously, to go there, but otherwise it is available in all states.
And one more question came through so far. What's the agent requirement to qualify for that trip?
Yeah, if you were contracted as of January 1st, the individual producer is $90,000 of weighted annual premium.
Perfect.
If you are contracted, I believe gosh, by April, I think it drops to maybe 60,000. Just depends when you are contracted. So, yep, 90,000 for individuals.
And if you guys have any other questions about that, we've got some nice postcards with those qualifications nice and handy on them. I can send any of those out as well. Next question, what's the minimum single premium for a juvenile policy? What's the minimum you'll take?
5,000. 5,000 for the juvenile.
Not seeing any other questions coming through yet. So while we're waiting, thank you so much, guys, for coming to this one again. There's a lot of familiar faces, so thank you for sticking through, coming to each one. Next week, we will be touching on disability. Kristen Burke will be hosting that one, but it's still going to be the same time, next Tuesday, 11 o'clock Central.
Mm-hmm.
And still not seeing any other questions. So if we missed anything or you guys have any other questions, feel free to give us a call. We'll make sure they all get answered. But Morgan, unless you have any closing comments, I think that about wraps it up.
Cool. Nope, I think we are good. We'll see you guys next week.
Awesome. Thanks, Morgan. Thanks, guys.
You bet. Have a good day.